crypto's reality check. The cryptocurrency market is experiencing its sharpest downturn since the 2022 crypto window, with Bitcoin shedding over 10% this week and falling below the $81,000 mark. Despite unprecedented regulatory support, Wall Street adaptation through ETFs, and favorable legislation, digital assets have failed to sustain their rally. The disconnect between the institutional enthusiasm and market performance raises fundamental questions about crypto's maturation as an asset class. Let's talk about the promise versus the reality out here. 2025 was positioned as cryptocurrency's breakthrough year. The ingredients seemed perfect, from a crypto-friendly White House to major asset managers like BlackRock and Fidelity launching ETFs, to digital banks exploring blockchain integration, and the end of what the industry has characterized as regulatory hostility. Yet, the markets have defied expectations. Bitcoin has surrendered all its yearly gains, and approximately $1 trillion in digital currency value has evaporated. In a single 24-hour period, over $2 billion in leveraged positions were liquidated. The institutionalization paradox. Now, here is the interesting tension. Crypto's integration into traditional finance was supposed to reduce volatility. As one exchange CEO noted, institutional involvement should make Bitcoin trade more like conventional assets. But this cuts both ways. Crypto now appears more vulnerable to macroeconomic shocks, including tariff announcements and broader market sentiment. The so-called crypto treasury companies that built business models around the token accumulation have particularly been hit hard. Strategy, formerly MicroStrategy, has seen its market capitalization fall from $128 billion to approximately $50 billion. So what does this all signal? The current correction suggests that regulatory approval and institutional participation, while necessary for mainstream adoption, aren't sufficient catalysts for sustained price appreciation.